The energy sector has been hit pretty hard lately, especially among some of the smaller and mid-sized producers, significantly underperforming the S&P 500 in the process, especially since late November of 2024. But while most investors are panic selling, legendary investors like Warren Buffett are buying billions of dollars worth of energy stocks. And guess what? So am I. In this video, I'll break down why energy stocks have been falling and why I think that's a great opportunity to load up on the sector, why Buffett and I are loading up on energy stocks right now, and third, my top energy stock picks for massive dividend income and long-term growth right now. If you love dividend investing and buying undervalued stocks, watch this video until the very end. And if you appreciate deep dive stock analysis, make sure to smash that like button and subscribe to my channel so that you never miss my latest dividend investing insights. Thank you very much. So why are energy stocks dropping? And why is that a buying opportunity right now? Well, energy stocks have been struggling due to several reasons. First, there have been some reduced geopolitical tensions. For example, in the Middle East and Ukraine, there's been a lot of talk about peace potentially in Ukraine as Trump is trying to broker that agreement, and that would certainly increase global supply of energy since there have been sanctions placed on Russia. Also in the Middle East, and while there are tensions there between Israel and Hamas and Israel and Iran, the threat of hot war has subsided some over the past several months. And so as a result, there's less of a risk of Iran's oil exporting machine being disrupted, or even Saudi Arabia's and other Middle Eastern nations that export oil there, oil exports being disrupted. Second reason why energy prices have been dropping a lot recently is that President Trump has adopted a very pro-energy production stance. In fact, he wants the U.S. economy to dramatically increase its energy production. In fact, has recently launched an American Energy Dominance Committee, and his focus is to increase U.S. energy production significantly with an explicit goal of driving down the cost of energy. The hope there is that by significantly reducing the cost of energy, it can fuel an economic renaissance and bring down inflation for the U.S. economy. And of course, that's not necessarily great for energy production companies because it would hurt their profit margins if the cost of energy went down. The third reason is that simply there's been a market rotation out of energy stocks. This is partly due to the fact that interest rates have remained high, and there are growing concerns about an economic recession, especially with the Trump tariffs recently announced. It's concerned that people are concerned that that's going to weaken the economy. Consumer sentiment has declined recently. Unemployment has increased recently, and those are all concerns that we may be headed for a recession, in which case demand for energy would go down, therefore the price will go down. So these are all reasons why the market is panicking and why energy has underperformed. But here's the thing. These are just short-term considerations. Each of these things are, and they do not impact the long-term investment thesis for energy. And Warren Buffett is a long-term value investor, and so he knows that, and that's why he's buying. In fact, 2 of his top 6 stock positions right now are energy stocks. Berkshire Hathaway is pouring billions of dollars into the sector, continuing to buy more of these energy stocks, even as prices drop. And I'm doing the same, and here's why. First of all, energy demand is projected to keep growing for decades to come. For example, the International Energy Agency, the IEA, forecasts that global oil demand will be higher in 2025 than in 2024. The U.S. Energy Information Administration, the EIA, they expect fuel oil consumption to rise 4% in 2025 due to economic expansion and industrial growth. Finally, OPEC predicts oil demand will climb to 120 million barrels per day by 2050, so they see a very bullish long-term outlook. At the same time, you have other energy commodities like liquefied natural gas. Their demand is booming. The EU is increasing LNG imports to reduce its dependence on Russian gas. Japan and India are expanding LNG imports from the US. And McKinsey projects global natural gas demand to rise by 10 to 15% through 2035. And that's not surprising given that, again, the AI boom is going to mean a lot of demand for natural gas to power data centers with clean and reliable energy. On top of that, U.S. energy dominance is strengthening. The Trump administration's energy policies could remove regulatory barriers for the sector, which could, again, make it easier for U.S. energy companies to invest in growth projects at more attractive returns than they would otherwise if they had to get through all the red tape. So, in addition to this outlook for demand in the industry, fundamentals matter a lot too, and that's where, to me, energy companies have really shined right now. In fact, I think they're in better shape than perhaps ever before in their history. The reasons for this are numerous. For one, energy companies are operating increasingly efficiently as new production technologies are developed and enhanced, the use of AI and other applications to improve the efficiency of exploration and production. And so as a result, many oil and gas companies are reporting reduced costs for producing energy. and extracting it from the ground. And that makes their break-even prices lower, which makes their dividends safer and their free cash flow more substantial. And this means that they can stay profitable even if we do go to an environment where energy prices drop. Additionally, energy stocks are good inflation hedges. And right now we have an inflation problem. The Fed has had a hard time bringing down inflation. And they're trying to do it with interest rates, but they're not able to go too fast. And in fact, now they've had to start cutting interest rates because they want to keep the economy on sound footing. And so I think we're going to have inflation at a fairly elevated level for the foreseeable future, especially with all the spending now being needed to be used for defense buildup across the world, because energy prices tend to rise with inflation. And so, that makes energy stocks not a bad pick. Third, they have strong balance sheets. And over the past 2 years, energy companies have used a lot of their excess free cash flow because energy prices have been elevated for the past few years due to the Russian invasion of Ukraine and supply disruptions that came with that, along with the broader inflationary environment. And they've used that free cash flow prudently. They've paid down a lot of debt. In fact, many of them have even reduced their dividend payouts in order to save more cash flow to reduce debt and to buy back stock. And so now they're priced cheaply because their yields fell because of the dividend reductions and because of the increasingly bearish outlook for oil. But now they're in a position to return a lot of capital to shareholders through buybacks, growing dividends at a rapid pace, and even some opportunistic expansion investments. So what are some of these energy stocks that Buffett and I are buying? Well, Buffett's two favorites are Chevron and Occidental Petroleum, and these are both large energy production companies that pay out, have a lot of free cash flow. They're buying back stock, they're paying out dividends, and they have fairly strong balance sheets, especially Chevron. Now, Occidental Petroleum, or ticker symbol OXY, Oxy, it's more of a deep value free cash flow play. It has an over 10% free cash flow yield. It trades at a very large discount to its net asset value. And so he's got a little bit of both. He's got the dividend, blue chip in Chevron, and he's got the deep value free cash flow high yield play in Oxy. There are other good opportunities. ExxonMobil is not a bad play just because it's grown its dividend for 42 straight years, trades at a discount to its net asset value, which is significant for such a vaunted company with such a strong credit rating and balance sheet, and it pays out a pretty good dividend yield of nearly 4%. So not bad for a blue chip. Of course, there are others out there like Devon Energy, Diamondback Energy, Permian Resources, others like those that trade at very steep discounts. And there's even Civitas Resources that trades at a massive discount to its net asset value. These companies generate a lot of free cash flow, and they're using that free cash flow to continue to deleverage already solid balance sheets, grow their base dividends, buy back a ton of shares. And I think, they all have pretty low production cost rates as well, because a lot of them are concentrated in the Permian Basin. And so that makes them attractive investment opportunities. Then, of course, you got Canadian Natural Resources, which I've talked about in some other videos. Pays out a very good dividend. It's a dividend aristocrat, basically. And it has very low cost of production with reserves of over 30 years. Just a really good management team that's done a great job at that company. And that's also trading now at a very, very compelling valuation. So with all that said, why are energy stocks such a big buy right now? Well, for one, they've been beaten down significantly in their stock prices, so they trade at very compelling valuations, whether it be price to NAV discounts, high free cash flow yields, in some cases very attractive dividend yields, very strong buyback yields, and they continue to deleverage, de-risk their business models. Of course, Warren Buffett, he's buying aggressively, pouring money into, especially into Occidental Petroleum recently. So that's a signal of his bullishness on the sector's long-term durability. And like we said, a lot of the forecasts show energy demand at least treading water, if not growing over the long term, which again, at these valuations makes it a highly compelling opportunity. And on top of that, the sector, again, has very good fundamentals. The cost of production is going down. They've got strong balance sheets. They're generating a lot of free cash flow. They're returning it to shareholders or further strengthening their balance sheets. And so again, I think the risk reward here is great. I'm not saying bet the entire farm on it. Buffett's not doing that either. But I think it certainly deserves a place in a diversified, value investing oriented dividend portfolio. So with that said, what's your favorite dividend stock right now? Are you buying this dip, or are you steering clear and waiting for even lower prices, or you just don't buy the bullish thesis on energy at all? Let me know in the comments below. And again, if you got value from this video, please smash the like button, help it get in front of a larger audience, and also subscribe to my channel to get future dividend investing insights. Thank you very much. See you next time.